Okay, in this lesson, we're talking about what financial options do you have when you start manufacturing overseas in countries like Vietnam. So the first thing I want to tell you about is something called factoring. Basically, there are companies called factoring companies that promise to pay invoices. They are willing to take on the risk to guarantee to pay the invoices for the goods that you're having made. Let's say you're about to start a production run with the factory and the total invoice value is $20,000, but you've only got $15,000. So you go to the factoring company and you basically borrow money from them, and then they'll guarantee the full 20,000 so that the factory can go ahead with the order. And if everything goes smoothly and you come up with that additional 5,000, and you're able to pay the full 20,000 invoice value that you owe to the factory to take delivery of your goods, then you just pay the factoring company the agreed upon commission. So they make some interest off of the deal. But let's say that for whatever reason, you're not able to pay the full $20,000 of the invoice for the factory. Well, then the factoring company will take ownership of the goods and then go out and sell them on the open market and make the profit that you would have made. So they're taking a risk that if you don't finish the deal, then they'll be able to take all those products and then sell them for a profit. Or if everything goes smoothly, they just get their commission. And what makes factoring companies unique is that they know the industry very well. So there's factoring companies that focus on electronics, or they focus on apparel, or they focus on food. And so they know the value of the goods that you're making, and they structure the deal in such a way that if the deal goes south, meaning that you cannot pay them back, that they'll go ahead and take delivery of the goods and then sell them for a profit. So that's what factoring is all about. Another option that's very common especially within the apparel business, is something called letters of credit. So some buyers, usually very big buyers, will want to work on letter of credit payment terms with the factories in Vietnam. And a letter of credit is a letter from a bank guaranteeing that a buyer's payment to a seller, a factory, will be received on time and for the correct amount. If the buyer is unable to make a payment on the purchase, the bank will be required to cover the full or remaining amount of the purchase. Basically, the banks sign contracts with both the factory and the buyer and guarantee that everybody will be paid as long as the terms of the LC are met. But in reality, well, first question is why would buyers want to work on letter of credit? And the reason is that some of the big buyers, where the order values are in the hundreds of thousands of dollars, they want to hold on to their cash as long as possible. So they'll do like letters of credit for 30 days, 60 days, or 90 days. So the bank will pay the factory after third-party final inspection and before shipment. But the buyer won't pay back the bank for 30, 60, or 90 days after the goods have been released from the factory. So it allows the big buyers to use that cash for 30, 60, or 90 days to either invest or do other business, make other orders, or whatever. But of course, the banks, they take a cut. They take a little bit commission from the buyers and take a little bit of commission from the factories. That's why most factories, they don't like to do letters of credit, because they basically have to pay the banks for the service, which really only benefits the buyer. But sometimes the factories will agree to do it, because then they're guaranteed to get paid in full before they release the goods. And as long as they meet the terms of the letter of credit. But that's where letters of credit are really more beneficial for buyers, because the letters of credit have a lot of detailed terms with a lot of like lawyer speak. And I've seen it happen where if the factory is not savvy to how letters of credit work, and they don't have lawyers on staff to read through all the fine details, and they just go ahead with the deal, then the buyers will accuse the factories of late delivery or quality control issues, or basically breaking the terms of the LC. And then the buyers can then just basically play games to their financial advantage with the factories. But we're talking about really big deals. If you're a small startup, then most likely you will not be working on letter of credit terms. But it's good to know. And if ever you, let's say you're doing wholesale and you get that first Walmart order for 200,000 units, and the dollar value is very high, and the factory doesn't think that you have enough financial backing, and they're not willing to go forward with the deal. That's when you go to a bank and ask for a letter of credit, and the bank will then check out the deal and your background as well as Walmart's background, because Walmart needs to eventually be able to pay. So if the bank agrees, then the bank will basically loan you the money and back you up and ensure that the deal will go through. But like the difference between a letter of credit and factoring is that the banks have no intention of taking delivery of the goods and then selling them on the open market for a profit. Banks are not in the business of buying and selling goods. They're just in the business of guaranteeing that everybody follows the rules and then gets their fair share and gets paid. So one other financial option in consideration is, what if you don't have enough money to make the deal happen? The factory tells you their MOQ is higher than you want, but they're not flexible on it, and you're just short $50,000, $100,000. But you know that your business can be successful if you can just get the factory to agree. So one of the options you have is venture capital. So my question for you is, are you prepared to go out and make a pitch to venture capitalists to get investors' money? And if you say no, my question is, what are you afraid of? Because if you really believe in your idea, and let's say you've only got $20,000, but you know, after doing all your homework and doing the math and talking to the factories, reverse engineering your target price, reverse engineering your MOQ, and knowing what the factories are willing to do, you figure out that you need $60,000. Why wouldn't you go to a venture capital firm, pitch your business plan like Shark Tank, and get their feedback? Because you've got nothing to lose. I mean, if they tear your plan apart and point out the weaknesses in your plan as to why they won't invest in you, well, then you know what you got to do. And you go back to the drawing board, you work on strengthening those weaknesses, and then you go back to them and you say, okay, I listened to your concerns. I made some changes to my plan. Would you please reconsider? And if they do agree to invest in you, that's amazing. That's a huge green light. And at that point, you have two options. You can accept their money, or you can refuse it. And you can go maybe to a different venture capital firm or to a bank and get money from somewhere else on better terms. But the important thing is that you want to be able to go through with the deal. And if it means using other people's money, if you can still be successful and still be profitable, why wouldn't you do it? So I strongly encourage you to, number one, write a business plan that includes your expenses projections and your sales projections, which leads to your income. And then when you've got your projected expenses, your projected income minus your projected expenses, then that tells you your projected profit, which is what it's all about. And if you can prove it on paper to a venture capitalist and they agree to invest in you, you're almost guaranteed success. The good news is that in 2025, you can use ChatGPT to help you prepare your pitch. And there's a lot of websites, matching websites like AngelList, WeFunder, Start Engine, where you can submit your business plan to these angel investors, and they will give you feedback. And if after either the feedback will be good and they're ready to invest in you, or they'll give you constructive criticism, you go address all those constructive criticisms and make your plan better, and then they agree to invest in you. Now you have enough money to meet the MOQs of the factories, and you can go forward with your business plan. So in summary, remember back to lesson 5, where we asked, what is the mother of all questions to ask yourself when making merch in Vietnam? And the question is, how much capital do you have to invest? If you don't have enough capital to meet the requirements of the factories based on their MOQs, then consider these financial options. There's factoring, there's letters of credit, and most important, venture capital. Remember, there's a lot of people out there with a lot of money that don't want to put it in the bank because the return on the investment that they get from the bank is lower than inflation. What they're looking for is somebody that has a good idea and is willing to work hard to use their money to make them money. And that can be you. So my suggestion is think big and don't be afraid to increase your quantities and take on a bit more risk as long as you've got a good branding, marketing, and sales plan and an excellent product. Then you'll be successful. In the next lesson, we're going to talk about where to go from here. See you in the next lesson.